How did Gresham House come to the decision that they wanted a tolling agreement?
It's essentially finding other ways of accessing revenues linked to the requirement for flexibility.
This is another evolution, which is ultimately the customer for you now is the utility, which is a completely different framing in my mind, an evolution of the role that batteries can play in the industry.
If each utility managed to balance their book, then there would be no need for national level balancing.
What's it been like, the roller coaster that you've been on your personal journey in this?
I think we're now at the stage where these higher renewables levels, the lower battery prices, the greater need for batteries, and the deep trading opportunity as it unlocks, would unlock a very large next cycle.
Hello and welcome back to Transmission. In this episode, Quentin is joined by Ben Guest, Managing Director of New Energy and Fund Manager at Gresham House Energy Storage Fund. The conversation covers the recent landmark tolling agreement with Octopus Energy, what this means for Gresham House and the wider battery landscape. As always, if you are enjoying the podcast, please hit subscribe so you never miss an episode, and give us a rating wherever you listen. With that, let's jump in.
Hello, Ben. Welcome to the podcast.
Hi, Quentin. Good to be back.
Yeah, well, I should have said, sorry, welcome back to the podcast. Wow, we've got a lot to talk about today. It's over 2 years since we first sat down in Gresham House HQ and talked about all things about your portfolio and your vision for the future. And a lot's happened in the last 2 years. Today's episode, we're going to go really deep into your new deal with Octopus, which is either the biggest offtake deal for batteries globally ever, or it's close. It's gigantic, and it's a big change for our industry. Before we do that, though, should we just set the scene? What is the deal, and can we put some numbers around it?
So we've signed a deal with the UK's largest utility, Octopus Energy, and the deal is to contract 568 megawatts from our portfolio across 14 projects that for 2 years each, that roll on and off respectively from between the second half of this year and roll off 2 years later, so in the second half of 2026. And it's a fixed price deal in exchange for Octopus to be able to really use the batteries as they wish in the market within the technical parameters set.
And just some more details around it before we dig into why and all of the things that could happen. How many assets is this?
It's 14 projects.
14 different projects.
Of different durations as well.
And what size of project are they in megawatts, roughly?
We haven't disclosed the specific projects, and apologies, we're a listed fund, so prefer not to say exactly the detail. We may be at liberty to do so in future. But, they start, at the smaller end, well under 50 megawatts. And a couple are above that.
We should have probably done a preamble to this, which is, of course, you run a public listed fund and there's some things you can and can't say. But I've got to ask, so our analysis puts this at around £56,000 per megawatt. Are we in the right ballpark for that as a price for this tolling agreement?
Yes, so that's in the ballpark. It's a weighted average across the different durations and assumes that all the tolls are running concurrently. So obviously they're staggered at the front end, at the back end, so that will change. But yes, that's a reasonable analysis.
And what percentage to put this in a wider Gresham House picture, what percentage of your portfolio is this? And another question is, why are you staggering it? Why don't you just get them all in right now?
The percentage is a little over 50%, I think 53%, based on our target portfolio of 1,072 megawatts once we're fully built. Why stagger it? I think it's a practical thing. So it benefits both us and the other side. It requires the installation of controller boxes as there's a technical handover of the site. So they need installing, they need mapping. If you like, the sites need to be mapped and reflected inside these boxes so that the batteries can be properly dispatched. So that just takes some time. So it's a practical thing.
And when you were first on this podcast, which is 80 episodes ago, roughly, I asked you, a lot's changed in 80 episodes. I asked you what you thought of floor agreements. And of course, the world's moved on since then, but we both agreed back then that the way that floor prices were priced at the time was so low, and you were giving away so much upside that wasn't worth it. And I think it was either your words or my words, or all congealing into one, which is, if you're going to invest in this asset class, then you got to be cool with the market, and therefore it's a volatility play, and you want to catch that upside. But then 2 years later, doing a tolling agreement where you've got a fixed price is a very different view on the world. So what's changed in your thinking and the rest of the team at Gresham House's thinking around this?
Sure. When you're evaluating a fixed price deal, or even a fixed price element of a deal, you sort of ask yourself why you take it on. What's the trade-off? So how much are you going to lose in revenues? And historically, when we've looked at floor price contracts, we saw no scenario or plausible scenario. It was so far below the low case, if you like, in terms of the merchant models, that which you'd be offered a floor, because bearing in mind that those floors also required you to hand over your capacity market revenues. So the safe revenues, were included in that sort of fixed price element. That it didn't feel like it was a good trade. Fast forward 2 years, admittedly knowing incrementally what we know about the market, which has become a bit difficult, and we've talked a lot about that in various different channels, including our formal reporting. We've now struck an agreement, not with an optimizer, but with a utility. And admittedly, some utilities also have optimization functions and trading desks that perform strictly optimization activities. But we've struck a deal with a utility that's offering us what in this market a very competitive deal to secure 100% of our revenues, and we also keep the CM revenue on top, capacity market revenue on top. So it's just a very different offer.
And that's a key part of it, isn't it? Because you've got in Gresham House, I'm sure there's things, I don't want to say anything you're not allowed to say, but you've got a range of capacity market contracts and a range of values, range of derating factors. And so this is X those capacity market contracts, some of which are as much as in the £20,000 a megawatt-ish, plus some derating. So there's quite one question about, I'm going to get straight into the details, sorry. So what happens in a tolling agreement? If you've got a capacity market contract, which is separate to the tolling agreement, who's responsible for dispatch in a capacity event?
Good question. Well, first of all, it's worth saying for the uninitiated, there has never been a capacity event or a stress event, as the legals would call it. But if there was one, there's an obligation to dispatch, and that's written into the agreement as being an obligation of the operator of the site, whether it's us or Octopus in this case. It's
a hell of a penalty if you miss it, right? But then again, there's never been one.
There's never been one. Yeah.
To come back, sorry, I got straight into the detail there. I get excited by this stuff. How did Gresham House come to the decision that they wanted a tolling agreement? How did you decide this is what you were going to do? Was it that you were approached by utilities and they said, do you want this? And he said, yes. Or did you say, this is the kind of contract that we want to structure? It's the first of its kind in the UK, isn't it? This is the kind of structure that we want. Let's go and find who can give us the best price. How do you do that process? Because it's never been done before.
I'll take a very short story. We've talked to the market, probably frustratingly for some, because it's sort of not a lot of detail provided, about seeking alternative revenues. And to sort of lift the lid a little bit on that, it's essentially finding other ways of accessing revenues linked to the requirement for flexibility. And of course, at the moment, we know the UK market as, and almost all markets, are national markets, where there's a requirement to balance the market. Why is there a requirement to balance the market? Well, first, electricity needs to be perfectly balanced in real time, second by second. But ironically, all the contracts out there don't require the suppliers or the offtake or the consumers to dictate exactly what they will supply or consume. So there are always imbalances that's left to effectively a clearing agent, the system operator, the ESO in our country, to execute. But we're aware that every single utility in the market has a supply base and an offtake book and has to balance those two as well. And so the alternative revenue exploration has been in that context and has extended to us potentially sourcing our own source of supply or offtake. Don't necessarily have to do both. And that's obviously a very complicated iteration to our business model to embark on something like that. But that's been on our mind for a long time. And suddenly, over the last 12 months, it's become clear that balancing of the electricity markets is being done somewhat inefficiently as a function of the skip rates on batteries and so on, and reduced our revenue opportunity. And so we've explored what's possible at what we call subnational level or a corporate level, in other words, utility scale level, and utility level, and discovered, an opportunity to partner with, frankly, more than one utility, but the one that's worked well is clearly the one with Octopus. But I suspect there will be new entrants as well.
Yeah, I mean, one of the things that is striking about this is to provide these kind of offtake agreements or tolling agreements, you really do need scale. You need to be trading a lot of volume. And what's implied is that you can, on top of the money that Gresham House with an optimizer could make, you actually have this additional value to your overall portfolio of having these assets as part of your portfolio, whether that's, reducing your imbalance penalties, costs, and whatnot. And that only really comes with scale, which is a big change in the market, because we actually have there are some fantastic small, nimble optimizer businesses in the market, but they, by design, they structurally cannot provide these kind of offtake agreements because they don't have such a big supply business. Do you have any thoughts on that?
We'll see how the market evolves. There's some fantastic optimizers out there. The reason why we've done this optimization agreement is because of this value of the hedge to the utility. And this is our inference. This is not necessarily fact. It could be wrong, but I'm pretty sure it's close to the truth, if not the truth. The value of this hedging capacity is incremental to the value of the asset, and so it gives the opportunity for a win-win. You're prepared to pay for hedging capacity as opposed to just wearing imbalance costs sometimes, especially during extreme events. And who knows if we see another Ukraine situation. But so I can't help thinking that more utilities will get into this market and maybe offer, tolls of different durations. And it might bring utilities and optimizers closer together, because I think optimizers are really teed up to, do that very well, while utilities will have to think about the combination of, national market optimization and, hedging of books at the same time. And that will require a pretty sophisticated trading desk. And it'll be interesting to see whether that does bring, independent optimizers and utilities together. That would be, a guess at what might happen incrementally in this market.
One of the things I found fascinating about it is, about the role of batteries in the energy system in general just evolves over time. And this is another evolution, which is batteries, rather than providing services to grid and just being there for the system operator, now batteries are being almost rented by a utility. And, the utility might get some frequency response contracts and ancillary services and other stuff. But ultimately, the customer for you now is the utility, not necessarily National Grid. And it's up to them how they manage it, which is a completely different framing in my mind, an evolution of the role that batteries can play in the industry.
Yeah. The way I think about it logically is, if each utility managed to balance their book, then there would be no need for national level balancing. So if the national operator is not going to go and do it, or do it well, let's go and find another element of the market to do it. And that's effectively what's happening at the margin here. It's very early days, but that's what we're doing. It's a sort of helping the market be balanced somehow, with batteries being used in preference to, our constant known, which is CCGTs, which we can go into if you like. But
I want to ask you some bits about the nitty gritty. I mean, when you and I first met, I was trying to sell optimization services to Gresham House. And back then, 2016, 2017, there wasn't any standardization of contracts, and writing contracts for optimization agreements was actually a very difficult thing to do. And they're all different. Lots of lawyers made lots of money, and I'm not sure we got it right, to be honest. But in the years since, there's been quite a bit of standardization and market norms. And one of the key parts of an optimization agreement is around availability. If the battery's available, then the optimizer can do what it needs to do with it. But if the battery is not available, that affects the optimizer as well as the asset owner. And I wonder, in an agreement like this tolling agreement, which is a new form of contract, how do you guys handle availability? Because it's unlikely, even with the best will in the world, it's unlikely that over a 2-year period, you're going to have 14 assets that are available 100% of the time. So how do you think about writing that down into some sort of legal contract? And how is it different from the arrangement you would have with an optimizer?
There are similarities and differences. Bear in mind that long-term PPAs and other sorts of tolling agreements do exist in the renewable space. So as a starting point, there's quite a lot of precedent. And then there are optimization agreements. So the requirement for technical availability, the requirement for batteries to be optimized and or tolled within technical limits, the need to meet certain availability standards to secure the revenues that are contracted, all feature, without giving too much detail away because we're under confidentiality. But common sense would suggest that there's an allowance for unavailability naturally for whatever reason, whether it's maintenance, pausing to do a capacity market capacity test, or natural outages that take place on the network. There needs to be an allowance for that, and there is in the long-term PPA, and there will be in this kind of contract as well. So there's a lot of standard elements that would be immediately recognizable in a contract like this. So it wasn't earth-shatteringly new and complex and so on to work through.
Another question, it's a little bit of a silly question, but it's important. How do you price a contract like this? How do you come up with that number?
We don't. It's offered to us, and if it works, it works. But in terms of how a utility might think about this in general is, and this is how I've thought about it, and again, it might be wrong because it's an inference, is I get some hedging capacity from these batteries. What can I make from them in the marketplace, a merchant market? It'll be X. If the tolling fee paid to us is X plus 10% based on the latest merchant environment, that's 10%. Let's say that 10% is equivalent to £5,000 per megawatt per year. You divide that through by 8760, which is your hours of the year, and that incremental, that shortfall that you're not getting covered in the merchant market is the cost of that hedging capacity. That number, it's £1 or less in the example I've just given you. That ain't a lot on a retail price of £200 or whatever the number is nowadays. So, it's something I'd certainly be thinking about if I was, a utility, because it doesn't feel expensive. It feels like a good trade. Of course, there's a risk that X falls and then the premium to X becomes much more than 10%, but it also could go the other way. So that's the risk you take, but the risk is relatively managed because you're paying something in the region of where the market is. Now, of course, the market's like to move very significantly one way or the other. Most likely upwards, given that there are so many tailwinds building, such as way more renewables being deployed, especially offshore wind, but lots of other things, meaning that we're heading towards a world of more than 50% solar and wind in the UK. ESO needs to start using batteries properly, or the costs of balancing are going to go. And the fact that the OBP is in train and will hopefully result in a well functioning market in due course as well. So likelihood is that the cost of this hedging capacity goes negative, and it's good for everyone if it does, because while we'll certainly not capture all the revenues, it speaks to a positive outlook for the fund beyond the tolling period and for the uncontracted assets. Of course, the trick it would be to, as a manager, would be to fix a toll for as long as possible at the top of the merchant market. That would be an ambition to try and achieve, because ultimately the revenues that you can lock in on a long-term toll will be a function of that merchant element, the bit that you can recoup from that tolling cost, plus you're hedging the value of that hedge. And the value of that hedge will move around, but I think the merchant revenue assumed that could be captured from a battery will move around as well. And right now, I think it's quite low. Who knows, in a couple of years, we could potentially reprice it at a higher level. That might not be the case. We'll see. Time will tell. But you can imagine how we would be looking to do this. I just want to touch on one other point quickly, which is you mentioned scale. I think scale was really important on our side as well. A large utility would need the scale to embark on a deal like this. But the obvious point is also that in seeking a large portfolio to use to hedge their book, supply and offtake, they're looking for a large operator as well. And at the size that we've done it at, I don't think anyone in the UK right now would have been capable of doing it. So that's the advantage of having some scale in the country.
And so many questions. I'll ask another one about the contract, and then I want to ask about how this changes Gresham House's operating philosophy. But how did you decide that 2 years was the right duration for a contract like this? What do you think? What does that mean about your view of the market over the next couple of years? And then the other parameter: how do you decide that 50% of your portfolio is the right number? Why not hedge the whole lot, or why not just hedge 20%? How do you think about this as someone who manages assets for a living?
Look, it's a judgment call. There's a degree to which there's a judgment call on both fronts. On the duration front, I do have a fairly strong view that the market will right itself for batteries. I think that the slight tangent, but I think it's relevant, is the market's very focused, partly because of how it's been talked about skip rates within settlement period. But I actually think the problem lies within reserve. So the pre-reserving of assets, I do think that starts to fix itself through the various milestones that we do see coming in the open balancing platform.
Could we go down that cul-de-sac for a second? So what does that mean, that the problem is in reserve?
In reserve, the problem is that the batteries are being traded within a half-hourly period, but by the time you get to real time, the flexibility provided by CCGTs has already been contracted hours in advance, because they need to be warmed up is the lay term. That's the term actually used for coal plants, but essentially it's the same thing. They need to be started up and ramped up gradually. And so they're contracted well ahead of real time. And so if you think about the market, the ESO contracted with CCGTs, they have complete visibility as to what they're going to get. And if they don't take it in advance, they lose it. In contrast, they could compare what's the cost of a battery in 2 hours, 3 hours time, but there's no contractual regime to secure them in that advance period. So they go, okay, well, the price right now for then is X, but that price could be 2X, 0X, or they might not be there at all. And then if we want to run them for 3 hours, which is what the CCGT is offering at any level to be flexed, we've got to daisy chain 6 sets of batteries together because there's a 30-minute rule. So, you very quickly realize that it's easier and more transparent and to just go with what's been there so far. But with the BDO, bulk dispatch optimizer, the ability to trade lots of batteries together, the state of energy rule, which will mean that the 30-minute rule goes away in about a year, a bit less, hopefully, and the launch of things like quick reserve, which allows for the pre-contracting of batteries in a competitive regime with CCGTs, but pretty much expecting batteries to win that, you end up with a situation where you've got batteries able to be effectively contracted, locked in advance with that, and therefore takes away the need for alternative sources of flex to be contracted in advance for fear that batteries might not show up. And in a world where we're heading, in combination to that, in a world where we're heading towards over 50% solar and wind, up from about 40% now, and then upwards of that, in a world where in this country, our combination of weather and renewables means that renewables can generate 0 to twice the expected average output at any moment in time. You end up with this really wild range of outcomes. Just moving from 40 to 50% is going to be massively impactful on the challenge of balancing the market. And so I can't help thinking that combination of things is going to sort themselves out over the next 2 years, hence the term that we chose.
Okay, so the implication is the change is happening in the balancing mechanism and to the system in general. You reckon the world will look quite different for batteries in the next couple of years, and that's why you don't want to lock in longer than that?
Yeah, basically. It's 2 years because, if you look at the front end of a curve provided by Modo or others, it's increasingly just pretty weak now and ramping up to a long-term stable level, which is discounting probably a bit of a flat market now, naturally, but and also a imperfect market in terms of how it's dispatched. Yeah. And I think things improve from in the next 2 years.
Yeah. And on the 50-50 point, how did you choose 50% of your portfolio?
Again, judgment call. We want to maintain some upside in case we're wrong. Where do you settle? Well, there was a degree of demand. So there was going to be a minimum level that would have been acceptable to Octopus. That combined with the fact that we wanted to maintain some upside and not be overhedged, if that's the right word, I'm not sure it is, or too heavily, contracted, given that there's potential for upside from here. We did enough to make sure that there was no risk of the debt facilities getting into a risky territory or anything else.
And can I ask you about how this changes Gresham House from an operations standpoint? Because surely for the 50% of the portfolio that you've now hedged, the key performance indicators for that business have actually changed, where there used to be revenue KPIs, and now surely it's a traditional asset management, availability, asset health, kind of nuts and spanners stuff, rather than being so close to the market and making sure bid prices are right. And so does that mean there's a simplification in your business and that you can focus more on asset quality than you could before with the limited resources that a business has?
I think what it highlights is that when you simplify the revenue regime, it reveals the importance of the technical aspect in either scenario really heavy, really clearly. Because the reality is uptime, state of health, and lots of other things are absolutely key in either. Because if you don't have an operational asset or an asset that's on, you're not going to make any money out of it. So whether that's in a tolled environment or in a merchant environment, it's the same. But it just highlights that point really, really clearly. So I'm glad you've asked the question. But it does simplify the commercial asset management. You're not, we've had quite a lot of optimizers on our books, and we still do. But worrying about the twists and turns in the merchant market dials down by definition. But it's still there. It's still there because we still want that upside to come, whether it's there's an extraordinary aspect of the UK market that's rarely talked about. It's just how low demand is. Demand has fallen 20% since 2007 and has yet to tick up when it's been forecast to do so for some time. So it's I don't know if it's the only market in the world, but most other markets have seen growing electricity demand, or at least less than substantially falling. But since about 2007, we've seen about 20% decline. And that's through probably efficiency standards and the degree of offshoring around things like manufacturing or just greater efficiencies. So that trend will reverse. But right now we've got a system sized for a higher level of demand. That will normalize. That's a cyclical point. That combined with the structural points of underlying EV demand and all things driving up demand, more renewables, and the market sort of correcting itself in terms of the OBP rollout and so on, really, should unlock quite a lot of incremental tightness or flexibility requirement.
And now I want to ask you about Gresham House and the overall market, because I know there's some things you can and can't say, so I'll let you be figure that one out. Gresham House is trading at the only way to be described as a massive discount to NAV. And that has implications for the business, for capital raising, for all sorts. It also is Gresham House's stock price is an indicator for the rest of the industry. And so how are you thinking about how the market is pricing grid? And
yeah, as you say, lots of thoughts. There are a few things to consider here, which start, first of all, be outside of grid itself. And when you say Gresham House, I just want for all listeners, Gresham House Energy Storage Fund, as opposed to the Gresham House previously PLC or now Limited, which is the manager of the fund. So essentially, we're a listed business and a listed investment trust company. In the years of zero interest rates, investment trusts were for many investors, the go-to place for yield-seeking investors, as a proxy to bonds, which were offering very little, or other savings accounts, which were offering very little. Since interest rates have gone up, naturally there's been a significant amount of selling of investment trusts, because you can earn 4 or 5% on a cash account or on bonds. And so there's been natural selling out of the investment trust sector. That's number one. Generally, when interest rates go up anyway, it's sort of the same point, but not quite the same. Discount rates go up, and therefore assets that are yielding go to a higher yield and fall in value. And in that scenario, discount rates tend to go up, but the market has corrected, whether it's the infrastructure space, the housing space, or REIT space, if you will, the renewable space, and also the energy storage space, gone to a discount despite discount rates going up in terms of valuing. So our NAV has come down from, based on mostly lower revenues actually in our case, but also high discount rates, from 155 to 130, with stock price, even after a significant recovery, still trading at 70. So the discount is very significant. Now, specifically on the energy storage space, the simple reality is that the market's been more volatile on revenues than expected. And whenever you get a disappointment in the stock market, you have sellers. And when you've got sellers who are significantly disappointed and potentially also worried around liquidity, debt, and in addition to that, it's an illiquid space. So there's thinly traded stocks, despite the size of the companies, things move sharply. And that's precisely what's happened here. And it went to very, very significant discount, I think up to about 70% at one stage. And that's the nature of stock markets. When you've got thinly traded markets, the share price moves can be very significant. And of course, another really important point is that this is a yield-seeking sector. A lot of retirees, savers, and so on look to this sector. And when you have to cut your dividend, which is what we've done to preserve capital and to just navigate through this period as a cash generative business, that creates the greatest disappointment of all, I think. And we've naturally disappointed and possibly lost investors in that. And it takes a long time to regain that trust. And we're going to work hard to do that. But that's the hard reality of what we're living through. And in time, we'll navigate out of this, confident that the market will recover, that the stock should not be trading at a discount to its replacement value. And this industry has scope to grow, and therefore is justification alone for things trading at a premium to cost. Otherwise, no one will build anything. Who wants to lose money on every pound that they invest? So, but that is what we've got, and that is, hopefully a strong message to whoever's can influence this among regulators, among decision makers, policy makers, and so on. This is what happens when you create uncertainty in a market.
And my next question is, how's it been for you? What's it been like running a business? Firstly, to set the scene, it's not really a secret that you personally have a huge amount of skin in the game and personally invested time, energy, capital, everything into this business. And I'm just interested, I'm sure our listeners would be too, what's it been like, the roller coaster that you've been on your personal journey in this? Could you talk to that for a minute?
Sure. I mean, it's naturally tough. I've been a hedge fund manager in the past. I've been an entrepreneur in the past. I've invested in all sorts of things and managed all sorts of businesses, and know what it takes to manage through different businesses with different risk profiles. So the experience is there to navigate through this rather than panic and run for the doors. But it's naturally very challenging, and the greatest thing that I've found myself doing is not just applying my experience as a fund manager, which is what you always do. You evaluate an investment and in the context of other investment opportunities in the portfolio, and you crack on with it and you evaluate. And of course, there's specific rules around infrastructure, such as maximize the return on day one because it's infrastructure. So you're living with that cost base forever, the capital costs in particular, and on the other contracted costs. So that's a key rule of infrastructure. And you're always trying to drive value out of projects and so on is absolutely key. But if other parts of the market don't function, and this is one of those markets where and elements of the market are dependent on other elements of the market functioning correctly. You're not selling widgets to a consumer who couldn't care less whether they need to be interplay with something else. We're not selling a widget with a funny shaped plug that doesn't fit into the plug hole. This is something that is functioning and should be used correctly, but has turned out not to be. And there are growing pains in the market. That's one way of describing it. and has meant that we've had to get on the front foot around that. And one thing that I've realized, this is a very honest comment, is that we entered the market because of its commercial merits way back in the day. We entered the FFR market and realized there was no need to wait for the EFR market. The FFR market was there for us if we wanted to enter into it. We knew that the wholesale market would be there in due course when it became the more interesting opportunity, or at least hoped it would, and that BM would be a key part of that. Turns out not to have been the case. But in entering a market, without the need for subsidies, for political support, for other kinds of sort of championing by quarters outside of yourself, you realize that there's no opportunity for, whether it's government or the regulator or anyone else, to really get up the curve around the importance of this sector and to really get comfortable. And if you think about what's going on in other countries, whether it's in Italy with the MATSE or the capacity market scheme, other countries like incrementally Germany or even Poland, certainly the US, either through a very vibrant market system in ERCOT or a RA environment in California, the market's set up, or being set up to ease the path for batteries. That hasn't happened at all here. In fact, if anything, there's this sense that batteries are not the suitable technology to provide flexibility because of the potential for a long duration issue, which is when the wind doesn't blow, or the sun doesn't shine for long enough that the batteries are exhausted. And this idea that batteries only solve short duration issues, which is nonsense, frankly. But there are various, we basically had to get on the front foot with our industry colleagues to really get the message out there of the importance of batteries and draw comparisons with other markets that are functioning. But that's the extra job that's required here, and it's not an easy one, because it's not financial analysis, and it's not sort of technical, the areas that you sort of lean on as skill sets that you need in renewables infrastructure. This is policy level work. Some people might call it lobbying, but it's essentially work at that level. And I hope the work we're doing helps unlock the need for batteries and prioritizing this really cost-effective technology for flexibility. And if we do need long duration backup, let's rely on what's there right now, gas, and then other stuff if it becomes commercial, but not try and confuse things by leaning on stuff that's either not technically capable or like to be available or cost competitive. So it's been I think that's the biggest element, and seeking for alternative opportunities, which is like such as the tolling deal. But I'll round out the answer by saying I think we've now gone through a big first cycle for batteries. We've gone for, since we started in 2015, 16, 17 in terms of early operational projects, we've seen a big cycle and reduction in battery prices. We've seen a big innovation cycle in terms of batteries becoming denser from a fire perspective, safer. And by denser, I just mean smaller. And that means that you can fit more onto a site, and, sort of megawatt hours per acre has gone through the roof, despite the need for spacing for safety, for fire safety and so on. We've seen a big increase in renewables. So we've gone from a world of sub 30% to above 30%, even 50% pretty soon. And we've gone from a world where we're looking beyond, in almost every market, the frequency response as the first port of call. We're moving towards this trading regime, and we're identifying and realizing in many markets that that's not quite ready, GB included. So I think we're now at the stage where these higher renewables levels, the lower battery prices, the greater need for batteries, and the deep trading opportunity as it unlocks, would unlock a very large next cycle. And anyone who's entering this market will need the team and or experience, the pipeline, and the capital to execute. And I think that's where we're heading, and we're trying to position ourselves well for that.
And just to bring it all back to the deal, how we started this conversation, the first thing I thought when the Modo folks came up with a number was that back when you could bid for 2-year FFR contracts, you actually would have been quite happy at 56 grand a megawatt plus a capacity market contract, maybe with some additional triad revenue. And so it's the market has we've gone through a huge cycle of higher expectations and higher expectations and higher expectations for revenue. And we're now settling down back to numbers that were actually quite reasonable only 5 years ago. It's a relative thing, not an absolute number thing. And then, of course, with CapEx coming down, it's an entirely different...
Well, we're quickly on that. Sort of the business case has evolved. So our view, and again, hopefully some policymakers are listening, the batteries, I think, in this country will go to at least 10-hour duration. I think the business case for 4 hours is getting very close at the margin. And, a year or two ago, 1 to 2 hours was sort of the trade-off. 2 to 4 hours is now rapidly becoming the trade-off at current incremental prices and thanks to the density that's available. So, yeah, it's going to keep evolving. I don't think revenue expectations have gone through too much of a cycle. I remember the very first effort, and maybe it's because we got in there before others got in there, but frequency response contracts initially priced, when we were looking at the market, was pricing in the £20s per megawatt per hour, sort of 150k per megawatt for a half-hour battery or 40-minute battery. So they were pretty chunky, and you had the triads, but not a lot going on the trading side because renewables penetration was too low still, and therefore the volatility wasn't really there yet. That came later. So we have a chart that we put in our publications, which show month by month revenues, which show the extraordinary range in revenues that our batteries have earned. Very decent in 2018, 19, early 20. Then the collapse due to COVID when demand disappeared, and the BM wasn't ready. The shoot up with frequency response, or the dynamic suite of frequency response services being launched. And then, the purple patch, if you like, through the very volatile gas price period through 2022, then the saturation in early 23 of frequency response, the flattening of the market, and the realization the BM wasn't functioning correctly, to the nadir that we saw at the beginning of this year. And who knows, we might be on another cycle. But it certainly, for investors, turned out to be more volatile. But the average has still been relatively healthy. But yeah, certainly it's been a big set of cycles there.
And you're still building megawatts. You're still building lots of megawatts. Do you want to just, please could you just share the latest on that?
Sure. We started the year at 690 megawatts at an average duration of about a little over 1.1 hours. We're through this year, and we'd largely built a lot of our projects, and we're getting now to the point where we're commissioning our projects. So we're moving higher, and because this could be published at any stage, I won't mention exactly where we are now, but look on our RNS feed and see where we are. But we're heading towards 1,072 by the end of this year.
Well, to timestamp this, there's still a Conservative government, and who knows what's going to happen.
Indeed. Yeah, that's an interesting topic of its own. And then we're heading towards about 1.6 hours, and we think there's further potential for upgrade, per my earlier point around sort of longer duration starting to make sense and so on. So there's a lot of value to extract from this portfolio, even beyond where we're heading now. So a relatively small amount of incremental capital is being deployed this year to unlock a lot of megawatt hours that become tradable as a function of that. And to use an Americanism, as you're based in America, our earnings power is going up on the back of that.
Ben, I've got to ask you about international diversification. So over the last couple of years, Gresham House was originally just GB, and then your board approved, I think it was 30% international, something like that. And then I can't remember all the exact numbers, it's been a while, but how are you guys thinking about international? And yeah, what's the thinking, and then what's the plan?
The thinking and the plan is to do so, to diversify internationally. I think certain markets are evolving to be very investable. Places like California are really interesting, where you can secure long-term contracts. Other markets where there's a leg up, whether it's capacity type arrangements, which is a bit like what you see in California, are all interesting and bankable as well. And I think probably the right way for markets to evolve, especially after the volatility that we've witnessed here in GB. So absolutely, we've been studying a lot of these markets. I've been and other colleagues have been traveling to explore other opportunities. Stateside, Australia, parts of Europe are probably the major markets. There are a lot of deep markets that are similar to GB in terms of the echo with our experience in general. So in terms of what you'd install, the levels of renewables growth, but but sometimes more attractive as a function of either the returns that are available or the degree of contracted revenues. So yeah, definitely an exciting set of opportunities internationally.
And then, Ben, another hot topic at the moment is asset disposals. Gresham House has got some assets for sale, and that must have been a big decision for you. Could you just talk us through how you decided to put assets up for sale, why you did that, and then as much as you can, I understand there's some things you can't say, but how's the process going?
So a frequently used term in fund management and portfolio management is capital allocation or asset allocation. And in a world where you can't raise additional capital, you have to raise it somehow, because a mantra we followed is trying to turn a pound into a pound something, 30, 50, whatever, to create the upside and the capital growth that this investment trust has enjoyed as the NAV per share has grown. It's really been a function of the IRR of projects being at a premium to the discount rate, despite the discount rate being pretty high. That's how you create capital growth in this sector. And you create that also creates a big margin of safety to make sure that you preserve value if revenue expectations come short, which they are at the moment. So how do you raise funds if you can't tap the market? You recycle capital, and so that's what the significant premise for this deal is, and that's what we look forward to executing on. It also has other benefits, such as creating a valuation event in demonstrating the value of these assets at whatever level prevails, but we can't communicate that. But we look forward to executing something and communicating that, and something at scale, not just a sort of small transaction that helps. The expression is proving the NAV, or as close as possible, one way or the other. So I think capital recycling is a hot topic in the investment trust sector, because you can't raise funds when you're trading below your NAV, and so proving that your NAV is a correct valuation and recycling capital are the motivations, amongst a couple of others. Portfolio rationalization and so on are the factors in our case, and we look forward to executing on that.
It's going to be fascinating to see, because Gresham House has got assets for sale and Harmony Energy's got assets for sale. And I know you can't comment on this, but I can, because we see the market. There's a lot of interest in these operational assets. And so there's a world where the share price is trading at a 40-50% discount. And then there's asset sales at above NAV. And you have this huge imbalance between a market event and the real value, and then the publicly priced value. It's going to be can't wait to see what happens. I know we've got a few more months to go to see what happens there, but let's see.
Yeah, let's see. When the investment trust sector has gone to a steep discount in the past, eventually that discount closes. Some of it might be NAV resetting, as we've seen a degree of, but of course, generally, if we get another interest rate cycle where interest rates start heading downwards, it'll be interesting to see what happens in the market, and transactions that evidence value will only support that.
Excellent. Lastly, is there anything else that we haven't touched on that you'd like to share with our listeners, or any thoughts before we finish?
Not especially. You've been very thorough with your questions. Thank you very much for having me on. And it's ultimately a long game, and cycles do turn pretty quickly, especially in energy markets. So let's see where we go from here. But the opportunity is still ahead of us. We are going to a world where we have upwards of 20 gigawatts of batteries by the end of the decade, probably upwards of 50 to 70 if we do go up to the higher demand levels that everyone's projecting. And I do think that, just to reiterate, batteries can do the vast majority of the necessary storage, and we should be looking at demand side solutions rather than storage or fuel solutions for those long duration requirements. Demand side, that's really important.
All right, you heard it here first. Ben, thank you as ever for coming on the podcast. It's great to have you on, to hear your view on the market. A very, very unique position, and congratulations on this deal. We're going to be tracking it in detail, as you can imagine. The good news is it's win-win. Either the price comes in below 56 over the next 2 years, and you think, my God, I'm glad that we did that. Or the price is well above 56 and the other half of your portfolio does well and we're out of the cycle, which is good for you guys as well. So we'll be watching in anticipation.
Thank you very much. No, I'm delighted to have done it, and let's see what else we do over the next couple of years. And I'm sure an awful lot's going to happen if it's another 2 years before we speak on the podcast. So it'll be very exciting to see what happens next. But there's a lot coming in this market.
Thank you for listening to Transmission, a Modo Energy podcast. Transmission delivers conversations from industry leaders and experts exploring energy markets and the operations and technologies related to grid-scale battery energy storage. Check out our other episodes by searching Transmission wherever you get your podcasts. Check out the Energy Academy, our video crash course on how markets in Great Britain and ERCOT work, or head to modoenergy.com to see our written research. Thanks for listening.